Very good morning to you all, friends. Thank you for joining this early morning with all of us. I welcome you all to this 158th program of AASB for this council year. And so far in these programs, more than 1,25,000 members have participated, and we have organized programs on a very large spectrum of the subject matter, which are required while carrying out the function of being an auditor. And today's topic is key consideration in audit of real estate sector. Key consideration in audit of real estate sector, because friends, real estate has certain peculiarities, including the recent Ind AS 115, which has changed the entire contours of the revenue recognition for those companies who are following Ind AS. And there are various other aspects, whether percentage completion method is to be applied for revenue recognition, whether completed contract method is to be applied, how the land banks are to be treated, at how the inventory is to be valued, how the inventory is to be verified, what is work in progress, what is capital work in progress. So there are various issues that we come across in the audit of real estate sector. So we thought that it will be better to have a specialized session on this. And I would like to thank CA Suman Chadda ji, the managing partner of TR Chadda, a veteran auditor, a person who leads from the front, a person who has built the Indian firm to such a scale that he has become a role model for so many of the chartered accountants. And the way he nurtures the budding chartered accountant in his firm, outside his firm, the way he contributes to the various committees of the Institute of Chartered Accountant of India, including the committee, my committee, in which is a special invitee auditing and assurance standard board. Thank you so much, sir, for taking out your time, and thank you for always being available for all of us. I know these are busy time for listed company audits, but thank you so much. And I would also like to thank our two young moderators. Of course, Suman Chadda ji is also as young as ever. The two moderators, CA Bharti Jain and CA Gulshan Grover, for accepting our request for being the moderator. This is a part of our endeavor to develop new speakers and new moderators. Our endeavor has been that to develop at least 200 new speakers and moderators in each council year through the Auditing and Assurance Standard Board. So thank you to the three of you. And also special thanks to the dear esteemed participants whose interest in these programs gives us the motivation of organizing more and more such programs. So thank you so much. And friends, with this, I hand over the proceedings to Gulshan and Bharti for taking it forward, and then to invite CA Suman Chadda ji for his deliberations. Please do send your questions, and our moderators will take up those questions with our guest speaker for the day. Thank you.
Thank you.
Thank you, Sanjeev ji, for such a wonderful introduction. Good morning, our dear friends. We appreciate the participation of all our attendees in our 158th seminar organized by Auditing and Assurance Standards Boards of ICAI. Auditing has gained significance with heightened standards, and thus AASB organizes these seminars to deepen our understanding of industry-specific intricacies. Today's focus is on the real estate industry, and as we explore the complexities of real estate auditing, our esteemed speaker, Mr. Suman Chadda ji, brings a wealth of expertise to guide us through this dynamic field. Please join me in welcoming him, as his insights are certain to enlighten and inspire us in navigating the nuances of real estate audits. I'm now pleased to introduce Mr. Gulshan Grover ji, who will offer further insights into our distinguished speaker.
Greater focus of various government agencies, specifically introduction of NAFRA. Earlier, we used to talk about specialization in some service lines. For example, some people used to get specialization in audit, some in tax, But now the time has changed. I think now we need to start talking about industry-specific specialization within audit itself, because every industry poses a different kind of risks and audit risks which need to be handled. So now, to start with, I'll give a small introduction of our distinguished guest for the day, Mr. C.A. Suman Chadda ji. C.A. Suman Chadda is a senior partner in T.R. Chadda and Company, which is a 77 years old CA firm in India, where he has been associated as a partner since 1984. With his extensive experience across multiple industries and service lines, he is a distinguished figure in finance and advisory services and has held many important positions in finance and accounting. He is an alumni of Shriram College of Commerce, Delhi University, holds a law degree and has been awarded with Ronak Education Foundation Gold Medal for securing the first rank in CA final in North India and second rank nationwide. He is also past president of Institute of Internal Auditors India chapter, which is affiliated to Institute of Internal Auditors US, and he is a part of their advocacy team in India. He has also served as special invitee to National Advisory Committee of Accounting Standards for implementing Indias in India, the Internal Audit Standards Board, the Auditing and Assurance Standard Board, and the Committee of Members in Practice of Institute ICI. He was the chair of Corporate Affairs Committee of the PhD Chamber of Commerce and served on its managing committee. He also has provided strategy guidance to various companies, being part of their board as an independent director. He is co-author of 2 books on corporate laws, widely regarded as authoritative text in the field, and he has been regular at various seminars organized by many different professional organizations, demonstrating his passion for sharing his knowledge and expertise. Without spending much time, I would like to invite C.A. Suman Chadda ji to start providing us guidance on specifically on real estate industry for today.
Thank you, Gulshan ji, for the kind words, and thank you, Chairman Saab, Sanjeev ji, for painting a picture which I may or may not deserve. But thanks once again, everybody. A very good morning, a cold morning. We have the coldest January since last 20-25 years. So maybe some of you who are listening weren't even born when the earlier record was established. When I was up as a young child, we used to have fogs so cold that the school used to be, we'll give a holiday. So, and then last 10-15 years, I didn't find that happening. So probably we've gone back to those times for this year. So as they say, winter is, when winter is here, spring can't be far behind. So with that aspect in mind, let's go straight and dive into very interest part, because when I started and I qualified, 1 second, this has to, can you see my screen, all of you?
Yes, sir. We can
Yes,
see.
sir.
Okay, fine. So when I started my career, by chance, I got involved in, very complex real estate clients. And we understood the nuances of actually auditing these and, doing the vouching and understanding how balance sheets are prepared at the micro level. So, and the journey was very interesting. And probably 10-15 years ago, maybe more, 20 years ago, I carried out a study of balance sheets. And it was very difficult to get balance sheets. Now there was no net, nothing. So hard copies of these balance sheets. So I had subscribed to one share of about 20 real estate companies listed, jitni bhi thi, so that I could get their balance sheet. And then I could analyze the practices. And it was, I was wonderstruck that, most of these companies had different practices for revenue accounting, etc. And the trend in the south was different, trend in west in Bombay was different, trend in north was absolutely different. So, for example, land cost was a major element for, and still is. And the cost of construction was far low, even less than 1,000 rupees a square feet, a few hundred. So land bank cost was very heavy. So the moment I buy land and break ground, I used to start recognizing revenue at POCM that already 30% of my cost is already incurred. So there was an analysis that how many companies would include, I remember, though not 100% accurately, but very few companies were excluding land as their component. So it was very easy under IGAP and the standards there. And before the guidance note came in 2012, on certain other parameters on this, and of course now migration to Ind AS. But before that, it became a very interesting exercise, and I published it. I think I gave a presentation in the institute only, I think, in one of the seminars, which was about 20 years ago. So it's like deja vu, and the clock turns 12 and moves on, of course. So that's how the complexity is. And now when REITs is there, data warehousing, there is a cusp of hospitality and residential and commercial and lease and buyback, and all the RERA issues. So the whole complexity is actually increasing, and real estate in India is something completely different from all over the world, at least in the developed economy. Hardly you see anybody European, investing in real estate for investment, buying land and leaving it for their generations. They would just buy their property, whichever, a flat or a house, whatever, their country house, whatever. And then they pay the EMIs and the loans of on 30 years. The rate of interest was in most of the time 1 or 2, 3%, on an average over the last. So it was very easy to, accumulate real estate. And at best, they could have one country home, outside, which is on a rural side or countryside. And that was how they acquired real estate. India, it's a different story. The moment you feel you have little money or you feel there is a need, you start buying land or book flats, and in multiple locations, multiple cities. So real estate becomes like a jagir for us, and it's done very well for generations. What my father invested in the 60s, I can never dream to invest today. And similarly, so I was lucky personally, and this is a story for millions of us Indians. So because of that, it gave a very robust opportunity for developers and developers of all kinds and shade to come into the market, because it was a lot of business opportunities, and the play of cash element, let it put it bluntly, always was a very big attraction, because you save on taxes, and it became a norm of how things were. Things have changed considerably over the period. Small and marginal players are, either in a very small segment, and the other players are aggregating into corporatization and the ability to present a cohesive picture of good governance, especially when we have FDI. One of the key areas of FDI in India has been real estate, apart from other, aspects. So that's been a very big push or a fill up to make corporate governance also an integral part of real estate business, which was kind of they never went together. Real estate company or a builder, corporate governance was not his priority at all. It was not in his dictionary. He was just buy land, and the way land was bought through aggregation, the Land Ceiling Act itself is a big impediment for transparency. All that continues to some extent. But I'm happy to share that, when we look at real estate companies now, the transparency has improved considerably. So this was the overall background of the industry and my little experience. But let me, without much ado, delve into what I talked about this. Sunrise Industries, REITs, warehousing, data centers, RERA has come in, state-wise RERA. The compliance is very rigorous. GST, Benami Amendment Act, that's also very, very, ALM aspects also come into this play. So these are the new developments in the last few years. And as I see these regulations and maturity models will continue to grow, and there'll be more and more rationalization of how real estate business is going to be run in the future. Just touch points: residential, commercial, industrial, hospitality. Many stakeholders here: the landlord, the owners, the builder, developers, because the builders and developers become different, because the ownership of land is one person, the building is done by another person, and the renting is done by another agency. So there'll be a little motley of people who will be carrying out one integrated development, and then there are contractors who are taken on board to actually construct and build a beautiful project for us. The agents, they play a critical role. Now agents are online, like 99 acres, etc., and stuff like that. But 99% personally, I feel people like to deal with physical agents whom they can show comfort with, but never trust too many of them. That's their way they look. Tenants, investors, of course, investors I've talked about. Now we have investors from all over the globe. One of the biggest funds like Blackstone and Brookfield, etc., they have invested billions of dollars of rupees over the last 5-10 years, and they continue to do so. And when India progresses into the 5 trillion, 7 trillion setup, there is no looking back for these investors. That's also a very interesting landscape. Revised guidance note on accounting of real estate transaction was a sea change, and like I mentioned, that there was a free hand for including land for considering as a cost to start recognizing revenue under POCM. But now this revised guidance note, which came a long back, if I may say, talked about at least 30% of the projected construction costs should have been completed before I hit the right side of my P&L account, the revenue side, for any income recognition. So that was a big changer from what my earlier assessment and my analysis had done. The RERA Act, which is very specific to each state, is rigorous. Compliance is, happening. People are not sure. They have to fill in various forms, etc. I, as an auditor, can take a lot of information from and what is being shown to me, because from the books, and what is being given to them as a, out of the books, like filing of forms. Then we have, of course, the other acts. The Urban Land Ceiling Act is still a problem, which is impediment, and talk about it when I talk about land aggregation. And these are the other acts which are generic as well and specific to real estate. So coming to the auditor, as an auditor hat, suddenly I'm given an assignment to audit a real estate company, medium to large size, maybe small size, one-off projects also have some of these. But, more than one project, multiple projects, then I think many of these risks would play in a much larger platform. And some of them I'll talk in detail. Some will be generic, depending on how the time progresses, because, we have another hour and a half to conclude this. And there is so much, and I don't think anyone can do justice in one session. There could be certain aspects which are more relevant person. But what happens is real estate, in any accounts, there is the revenue, the profit and loss account with the income side, the expenditure side, and the balance sheet, the assets and liabilities. So in real estate is one of those areas where all four are nebulous in terms of availability of options, guidance, risks of material misstatement, and how record to report process goes through in any organization. Here, they gives a lot of leeway, as much as the accounting standards and guidance notes are trying to control it. But in my mind, still we have a vast field to play with. And that is where the auditor has to get hit to his skepticism cap. We have to be very mindful of how it is progressing. Not only have to see the trial balance in the accounts, but I have to be very aware of the business of the client. Which area is he operating in? Is it how are the other real estate developers or builders or businessmen managing their affairs there? What is the market scenario? What are the ads which are coming for sale or purchase or distress sales? How attractive that market is, how sluggish it has become. We go through various cycles of real estate. If you see in Delhi and Noida and in the NCR and probably in the country, nobody in their wildest of dreams, at least I really have not found anybody who could have imagined that after COVID, the price escalation and the demand for real estate, whether it is individual flats or houses, has gone up so much that 2.5 times some of these properties have increased, which is unheard of in any normal circumstances. But since 2013 till probably 22 or 21, it was a stagnation. Hardly prices were increasing. So people took it as a granted, and then they, said that real estate is not in favor, and suddenly it's gone back. So I spoke to a builder and said that your prices have gone 2.5 times. But he said, Mr. Chadha, what are you talking? That it's not too much, it'll go again. Because if you take the average from 2013 to 22, there was no increase. And suddenly in last 2 years, it's doubled. So even a small saving account would have got you more. So that is how this sector is built up. But revenue recognition, I'm going to talk in details, because what happens is, even today, circle rates, of course, are maturing and coming in line. People are wanting to take bank loans, so they have to show the full amount. But there is sometimes a strong possibility that either the buyer will not have enough, may not want to give full check payment, or the seller, because he's done one transaction at a particular rate. Even if he wants to, take full check, he's not able to do it. As an accountant, this element is outside the books. Am I having any ability, any guidance or hints or some kind of evidence, which will help me to mitigate this risk and improve my assessment and cover up in my audit that whether such elements existed in this particular set of transactions or not? That is still $1 million question. We don't have full answers to that. But if we understand the ecosystem a little better, there would be smaller and smaller ideas and of hints or indicators or to confront the client on that. So I'll be switching off my video also. Sometimes the internet goes down after a while, and after a while I'll come back, but I hope the screen continues. Similarly, construction budgets, estimation process. When I start a project, I have conceived something else, but there is so much of variables, cement, steel. There's so many other elements involved. There are different subcontractors which are involved. The biggest problem in real estate is the delays, the inherent delays which are there in a large number of projects because of myriad reasons, multifarious reasons, because of non-availability of regulation approvals, non-availability of land aggregation, sluggish market, so I don't launch my project, delays in execution, because it's still a very difficult industry to execute. Unlike probably globally, China, I don't know how it does magic that, within a few months, it creates building worth hundreds of, stories. We are still not able to do anything close to that. So how they process this, these built up equipment, floors, they come quickly. It's become something which India is working on, but I think a long way off. And then the material which we use, the technology, cement and steel, and the concoction we do, to build up, and the enforcement through steel and Sharia, and the way aggregation happens is a old process. But now, for example, we built Ayodhya temple. Ayodhya temple does not have even a gram of cement or steel. It's only built in stone. So, and as it's being said that it will last 1,000 years. So that's how our old temples and the entire construction of the world, right from the pyramids to any other monument, there was no steel or cement there. So these were stones, and they were bound together by different bonds, etc. So, but technology is changing. We need to do quick, light, cost-effective ways of bit. When I do my accounting, I get confounded by cost escalation and estimation process, which is very relevant for my revenue, goes haywire. Now we have, purchase and vendor selection, advanced deposits paid toward land procurement, etc. So these accounting become also very nebulous, because what happens because of the land ceiling? Invariably, I've seen, especially in the NCR, one builder would have 70, 200 companies, 500 companies, because they can buy only, each of these companies can buy a small section of a larger project, few hectares or few acres. Not only that, if I'm going to launch a project, most of this land we have usurped from the farmers. They are the ones who were the actual landowners of the country, and they are now being marginalized. Some of them are happy because they are getting a lot of money. Some of them are unhappy because sometimes the government acquires and their compensation is not commensurate to what the market is, and they have to go for court for escalation, etc. But the builder, a prominent builder, would never want his name to come when I start aggregating land, because then they become very choosy. And even if a small plot of land critical to the whole contiguous nature of the project is gets stubborn, that farmer, the whole project get delayed, and it can get delayed for X number of years, for as long as decades sometimes. So they create these front investors. Maybe they are mostly brokers who are, have confidence of the builder, or other intermediaries who are in this play as land aggregators, and they will open these shell companies with funny names, and they'll just buy a plot of land and keep it till it is required to be aggregated, and then we have a contiguous land of say 10 acres or 50 acres, whatever, and then ultimately, whether they are my subsidiaries or they are out of my books. If I'm listed, I may want to have them as subsidiaries, but if I'm unlisted, I want to keep them away for lack of transparency. So their consolidation becomes a very big challenge for me. And how do I value them? How, they are done by small audit firms, because there's no entry during the year, maybe some minimal transactions, only the land is sitting in the balance sheet, and probably some unsecured money or advances have moved from the main parent company to them to buy that land. So that also has an implication in my balance sheet. What happens to these companies after the project is delivered is another, issue which we have to talk about. So we can go on each of these parts, because practically, if you look, it's a very complex exercise. It's not easy for these developers. Now, what happens when I have inventory, PP, investment property, how work in progress, capitalization, property, plant and equipment, whether I put it into that schedule or whether it is an investment property, is a very thin line. I'll have to do my best judgment, see all the parameters involved, and still take a view which may differ, and rightly so, by another consultant or auditor. Carrying value each year, because projects can be delayed and they may take a very long time. So every year I have to, and for listed companies, literally every quarter, if there is some significant development, to assess these carrying values. Then we have the concepts of interest rate risk, how I built in the model for interests, whether it is to be paid on my borrowed funds, or whether I'm going to charge for delayed payment from my customers, or have to pay to the customers for delayed Possession, that's also another area of accounting concern. How do I price the property? What are the circle rates? Circle rate will change anytime. And then we have an issue. I have to see my competition, but if the market is suddenly collapsed, then can I bring the prices down? I have sold a particular flat to a particular set of customers 5 years ago at X price per square foot or per square meter. But now the prices are low and I'm unable to move the property and I need the cash to repay my bank and to conclude the project. But if I bring the price down for the next set of customers after a few years, the old customers will come to my throat and say, yeah, I need my money back. So that's another area of concern, which is practical. And then how do you account for it in the books? Land prices, because there are cash transactions, so there could be issues of fund diversion and facilitation payment. This is a problem. We have to face this problem that real estate transparency is not there by the approvers as well. There is so much of difficulty in getting approvals, and there could be other facilitation payments involved, and that's rampant throughout the country. But I might say that this has come down significantly, but still it is significant from what it needs to be actually, on record. So the RERA aspect, the way transparency is there for e-governance is really helping this aspect, because everything is in the portal, approvals and in the portal. The files have to, movement of files can be traced by anybody. RTA is very active in this sector. One of the most active RTA sector is real estate. What's happening, and whether it's a double mortgage, I've bought a flat, has somebody else bought the same flat, etc. There's so much of things happening. And then we have the consumer courts, which are very active and very compassionate to people who are suffering. But now the NCLT has taken over very, very many real estate projects, and they're bringing in guidelines to smoothen that process, because that's the biggest failure of the NCLT, the insolvency, sorry, not NCLT, but the insolvency resolution plans. Because real estate home buyers are the biggest sufferers, because the first charge, a secured charge, is the bankers, and the priority is taken by them. And how do these home buyers who have actually taken on rent flats to be able to move into their own dream house, which everybody wants to have. And one, they don't have possession. One, they're paying rent. They've sold off their old houses to pay the deposits, and they are actually suffering. We have related party transactions. One, whether these landowning companies are under my related party transaction, or are they covered parties, like, not under the Companies Act, RPT, but they may be connected parties. Connected parties is a very nebulous subject, which auditors now are wanting to, being asked to look at, even by NAFRA, etc. That typically the threshold of related party under Companies Act or other laws are not going to be met, but still it's connected to me in some other way. So that's how things are for RPT, very important for real estate. Impairment assessment, borrowing cost capitalization, it's not allowed in most of the cases. Going concern, DTA, because, if I anticipate, if I book revenue on POCM, and then, there is a virtual certainty versus, reasonable certainty, that also comes into play. Customer claims litigation, what to take on books, to make provisions, what not to. So all that is going to be very relevant for me. So what can I do? What the management, I expect the management to do. I should have a risk management framework. What do I mean by that? I should have SOPs, I should have DOAs, I should have various controls, automated or otherwise, against each of these major risks. Many builders will not be able to, demonstrate that they have these RCMs in place. But large organizations, and of course now listed companies with their board audit committees and those charged with governance, this is an important and a critical and a compulsory framework which is required. We have a risk officer, a risk chief officer, who has to drive this. But if there is a good, simple, good working model for risk management framework, this is the risks, this is the controls, This is the way I can audit these controls. Where can there be a gap, a blind spot, or an over control? This gives a very good top level comfort that something is happening. And then I can, when I do a walkthrough of these controls, it gives me some level of comfort or maybe discomfort, but at least I'm not lost at sea. I have a little, um, holding on to this rope, though I'm thrown overboard with the sea, but I have this rope which I'm holding on, and that hope can help me to navigate the deep waters when I audit and give my opinion. Site visit. It is a tremendous eye opener. I tell my team members, or I encourage everybody to just see the site. Kitna kaam hua hai. Books mein, there will be multiple projects all over the country, large real estates. You will get an assessment of whether, there's any labor there or this is closed, nothing has moved 6 months, or just come and the management assertions come. I am absolutely in tune and give me a lot of comfort. Secondly, data analytics, basically, idea software tools, etc. When there are large number of expenses, there could be variations, even micros on my Microsoft tools will give me outliers, will give me exceptions. Maybe there are some false positives, but I'll have to sieve them out. So basically for payments, progress reports, inventory, there's so many items which are relevant for me. So data analytics is also very important because there are too many aspects to see manually. Periodic audits, like, of course, if it is not a listed company, but still I may need to do an audit for one specific project which is complete or nearing completion, to be having comfort rather than doing it at the year end for all of them together. Ensuring that the sale values are such that they reflect the market value. So the possibility of any cash element is, if not eliminated, significantly ruled out. Legal and compliance, because there are maximum number of laws which actually required, whether it's on labor side or RERA side or urban land ceiling compliance. GST is another issue which is troubling when there are collaboration agreements, etc. And of course, what is the level of training to the people on ground who are not only recording my books but also giving the input for this estimations, completion of projects, and the stage in which sales have taken place, and their interaction with the CRM and the other customers, and how many sales have been recorded properly, whether the payment flow of these customers are in real time, which I can see for myself. Internal audit, I think it's a very happy hunting ground for internal audit because, there are so many touch points, so many weak links that invariably when I get a real estate internal audit, I feel very happy कि इसमें तो बहुत कुछ निकलना ही निकलना है या कुछ मिल सकता है अच्छा, because, you have that opportunity. It's not, one input and one output in a machine, but there are so many areas I can get into. Disputes on title, it becomes a major issue in real estate because there will be challenges from families, from government, from not very transparent land records. Reformation is very much important, and it's happening. They all have to be now, marked on a portal, but on the rural side, it's still very nebulous. So that's something which I'll have to be very consideration. The accounting framework has changed significantly. Chairman sir also mentioned, the coming of India's 115 revenue recognition from contracts with customers has been a game changer. It is basically for all those, where India is applicable, listed companies and for companies with net worth above 250 crores, I think, which is the threshold today. So as the company matures, I'll have to migrate. But the in-gap will continue to be governed by the revised guidance note on accounting real estate, which was revised in 2012. I'm not sure whether a further revision is also being planned on this to make it up to date on 2024 by AASB. But since they are working on projects, I'm sure this will be also part of the agenda. And 9 and which came, but we need to update most of them because the realities of the rights and the warehousing and complex real estate transactions, etc., have to be in line with the world practices. So control model, how do I risk and reward? This is something, the principles, whether I have control of the property or I've given control, ceded control, Indians who talk about that, the point of time over time. So this concept is very important. Typically in IGAP, it was point over time, that as in when I expend and my estimated budgets of expenditure and revenue, I start booking notional income. I may not have received 1 rupee from the flat owners or from the customers or potential customers, but I'll start booking revenue. Indians will have a totally different flavor, because unless I cede control to the customer or buyer, it may be very difficult for me to recognize revenue. So it's generally more conservative, but there are various scenarios where things could be changed. By and large, I think that should be a thought process for understanding. Like I mentioned, completion method, percentage of completion method, both of them are looking into it, but main thing is the control. Control has to be ceded, then only we can proceed. Whether revenue to be recognized over time or at point of time. But for now, we'll park it here, and we'll just move on to the other parts, which creates more complexity. For example, barter transactions, joint development agreements. I typically in South Delhi or most of Delhi and probably all over the country in urban cities or developments, we have a JDA. I own land and I want to encash the land, but I still want place to stay. So one option is outright sale, but the more popular go-to option is, I get a builder to do a joint development agreement where if I'm making 4 floors, now we have 4 floors plus basement plus. So I retain all that and give 1 floor to the builder to sell, or it could be any other arrangement where the ownership, how do I give when do I say the ownership is being ceded to the builder, and when does the customer step in? So this becomes a little complex. Then we have fixed price agreements. There could be escalations for development agreements where land is owned by one person, but somebody else comes and build it, for a large project, because investments are huge, my friends. It can run into billions of dollars for one major project. And then the whole concept of who owns the land, who will make the building, who will be responsible for construction, who will be responsible for sales, how will we share the spoils of the revenue or suffer the losses, is also going to be a major issue, especially when there are multiple companies, multiple transparency is not there. Sometimes when as a builder, I'm given space in the building also in various floors for large projects. So that's also, when do I, if a buyer of the builder, I'm the builder and I'm getting few floors, when do I started accounting it as my purchase and then I sell it through my channels as sales or purchase. Delay in compensation is another issue when we are looking at land acquisition. India is on a very biggest development mode we've ever seen. So there is thousands of acres and hectares of land which is being acquired all the time. And the owners, whether it's the farmers or urban belts, and whether the roads are being made or airports or ports or whatever that might be, compensation doesn't come so quickly. I have to go to court most of the time. Courts, we know how they perform. They have, justice delayed is justice denied. It may take years and years. Will I get interest? Will I be alive till my compensation comes? Who will enjoy that compensation? Nobody knows. Sometimes they have buyback obligations. So that also has to be taken into account. They have some onerous contracts. So we'll get into some of these, not all of these. So mapping, this is one key thing, one simple exercise we can do when revenue, there are multiple flat buyers. So apart from any element of something which is not recorded in the book, which is another fish news properly. So I have to map the customer-wise receipt list. So we have these salespeople, we have a CRM, whether it is automated or manual. Most of it now use various CRM softwares. And to individual sales listing as per allotment register. So when we interact and when the branches or branch managers or sales managers are interacting, so they will keep record of their sales with customized receipt list in my accounting. And so the accounting team has to talk to the sales team, and that integration is very important. They have to have that comfort that everything is tallied, because there's bound to be mismatch because of timing difference, because of so documentation. I create a sale, but have not, the buyer has not signed the allotment full of paperwork. So I may not be a wise conservative revenue decision to book that. So unless that mapping is done, whether through a software or manually, my comfort that all revenue which should have been booked has been booked and nothing excess has been booked, depending on the requirement of the promoter, how he may want to play with it, or it may be just mistakes which need to be taken into account. Connected to that is the cutoff procedures. Because when do I recognize the revenue? When I actually sign, whether I get the check, whether I get the part check, and the formalities are pending now. A lot of KYCs are requirement. If a registry is there, registry may be getting delayed. There can be multiple buyers. There could be other considerations. There may be certain covenants which the builder has to do, to complete the flat. Some finishing work is pending, or some other critical development of the landscaping is pending, etc. So I don't want to take possession, but sale has already taken place. So cutoff procedures also are very nebulous, very complicated, and for an auditor, it is also very complicated. So my friends, I'm not sure. We may want to break some time, but we'll do it after a few slides. Around 12 noon, we'll break for a couple of minutes, have a breather for all of us. But till the time, we'll cover a few things. So testing of journal entries. This is a key test these days, my friends, which is required for all audits, even NAFRA and PCOB worldwide, that I have to test journal entries for any outline entries, because everything comes from the trial balance or the ERP. And then, these journal entries which are passed at the end, which are manually passed or passed through Excel sheets or put into the software. It could be anything. When I do these tests, whether it's a month end, quarter end, year end, I realize that, are they correcting any mistakes? Are they genuine journal entries like year end provisioning, etc., or there's some backdated adjustments now? The audit trail has become very significant. I'll touch upon that later. So what is the amount demanded? What is my software showing that how much is collectible against how much is collected? And higher variation between sales per square foot or meter between one customer to the other has to be looked into very carefully from a practical point of view. Now, POCM is the biggest tool available to book revenue. It's not a simple purchase and sale for a trading or a manufacturing company. If I sell an item, I book revenue. Here, my revenue is mostly unlinked to the money I'm getting, the cash flow. That is why, my friends, the builders who get into trouble is because of that. The balance sheet may be healthy and, nobody will get a sense. But if the cash flows are not in match with them and their cash obligation to their, their lenders, whether it's bank or unsecured loans, and when you go to the market to borrow for real estate, then you are the last of the heap. Nobody wants to touch you unless you're an individual customer. I'm talking about builders. There's always a very risk. Immediately you bracket into a risky category, and many banks, NBFCs, institutions don't lend to real estate projects. And where they have lent, they have burned their fingers very badly. So retail is the flavor today. But of course, marquee projects are also there. They don't want to miss on that. But then now they're devising various ways to do the lending on that. So am I having a robust system with senior enough team members who are a cross-functional team from the technical side, finance side, management side, marketing side, who is involved in the POCM exercise when I determine my budgeting costs of the project? And if there are multiple projects at different stages, how do I allocate that? And also the revenue which I estimate to generate from that today. But that narrative may change within a few months or a few years. So I have to continuously update my estimates on a very rational and a proper basis to analyze the variances, because otherwise, I may start on a particular assumptions, but at the end, and in real estate, it happens more often than not that the actual reality is totally different. You may hit a jackpot like the builders have done in the last 2 years, or you may get into a slum like the builders faced 7, 8 years ago. Site visit for me is very important, as I mentioned earlier, to see exactly what is happening. Completion link plan, how I demanding the money from my customers, whether it's percentage on plinth wise, or completion of a particular thing, or the POC as per my books, I'm going to book revenue. Confirmation of balances, very difficult to people to get balance confirmation, especially from these vendors, from landowning companies, from unsecured loans, etc. It's a big challenge for audit to get confirmation. So I've sent the confirmations, but if nothing comes, then my audit procedure is taken to another level, and then I'll have to get into the discussion with the management that each of these large balances which are material and they haven't moved for a particular period of time, and if they are recoverable, etc., how in absence of balance confirmation, because it's not the norm in this industry, if I send a balance confirmation to a customer, he's never going to respond. And similarly, if I'm a customer, I'm sending to a builder, because they always feel that there's something, if I commit now and if I want to charge something retrospective or interest element, then I'll be under the wrong foot. Customer files, a lot of customer complaints. So they have now portals which have to go through that. What are they talking about? What is the noise on their side? To identify the discounts, rebates, because if I'm giving rebate to few people or a large number of people, then the whole, my estimate for revenue is going to be totally shaken up. So I need to go back to the drawing board, to the Excel sheet, to my assessment with the management to relook at that. Sale deeds, transfer of control. Here again, I have to look at very relevant for Ind AS, especially when I do the completion method of accounting. Another new development act. Now it is very state specific. It's still evolving. There is a forms like Form 3 and 5, which has all the details which have to be filed mandatory. There are various do's and don'ts here, which are very strict, and I have to comply with them. So for an auditor, it is a very good blessing, because if that organization or the real estate company is actually complying to RERA guidelines in some measure, then they will be filing these forms regularly. And this gives me a very good source of comparing my accounting records and my assessment of the risk vis-a-vis what has been filed to RERA. Because everything under one particular project, everything has to come to a designated bank account, for example. This was the biggest problem in the real estate sector. One of the biggest problem is that when I start a project and immediately on booking, if the demand is good in that area or the times are good, which is more often than not, I'll get a flood of money from, these days, within minutes, if not hours or days, the DLF projects get sold out. It's kind of amazing who's buying, are these investors, speculators, land users? We don't know, end users. But that money I get, what do I do with it? I don't need that. I haven't even started construction. My contractors are still to be taken on board. There's no mobilization advance which I have to give. I have excess money. So what do? I can put it in the bank account and earn 7% interest, or I can buy land. My eyes are watering with more money and hope for profit. So I get into various other projects. I divert money. Now, diversion is a very nebulous word. What do you mean by diversion? So if I surplus money, it's my money, I can use it anywhere. But if that project goes, delayed or jeopardized and I'm unable to get the money back to start construction here, there is where the big boys of the Indian real estate companies which went under IBC or are having serious difficulties um, are facing. So bank account gives me a very good idea of where the money is in and outflow, so I have a better control. TDS Form 26AS is my good Bible. Whether 1% deducted by the buyer at 1%, what has been done, what is the revenue advances, is there a mismatch, what are the models of revenue recognition I'm doing, whether it is selling or leasing, lease assets, whether I'm treating it as house property or business property. So there is a lot of action there as well. So I talked about land advance process. They need to have some controls. Who's authorizing that? What is the due diligence? What is the market surveys? What is the the legal due diligence on the titles of these properties? Is there some underlying agreements? Is it like just advances to these farmers, and agreements may come much later? Because I may want to sign the agreement finally with my promoter company, my main company, my marketing company, my branding company. So I don't get into any, and then there is a cascading effect of double taxation. If I get registered today, I have to pay stamp duty, 6, 7, 5, 6% or whatever it might be. And then again, if there is again transfer, so I hold the transfer. So that gives me, the auditor, a sleepless night that transfer hasn't happened. Has the possession been taken? What are the underlying agreements? Is the trend that the transfer actually undertakes finally when the complete aggregation has happened, etc., and the project is launched? Very important for me. So verifying the underlying agreements or memorandum of understanding. So based on the land advance, what is the timelines mentioned? Is there a covenant that if the full money is not paid, the land will go back? I'll have to be very mindful of that. Land aggregation, legal experts, legal opinion on compliances of the Urban Land Ceiling Act, etc. That I don't want an acquisition, forceful acquisition by the government because of violating that. So friends, we'll break for a few minutes. We are on this 12 noon clock chiming. So I hope that's fine with all of you. Grab a cup of coffee or whatever you need to do. So we'll see you at 3 past 12. Thanks.
Participants, you can keep sending your questions. We will take all of them towards the end of the session with Chadaji. So keep sending them.
Yeah, we can start now. So, assessing recoverability, viability, including assessing long outstanding land advances. So what happens, we have to obtain detailed summary from client on the status of conversion to land stock. So ultimately from fixed assets to land inventory, once is inventory, then my valuation norms will be totally different. I'll have to obtaining audit evidence as regards subsequent developments for land purchase. What happens when I give land to advance to land aggregators after the project? Ultimately, these companies have no meaning. The underlying land has also been sold. So I have to merge these shell companies maybe into my parent company or liquidate them. That again is a challenge, and we have to look into that. Site visits I've already talked about. Market rates, guidance value. This is one of the biggest things which can help me to be a good auditor. Have that sixth sense. What is the market trend? That's very important. I just don't go and audit the accounts. I need to audit the environment also to see if I'm missing any chance of material misstatement. Is there any blind spots which I'm missing? Any risks which I'm not able to cover? This gives me a very good comfort. And also, if things are all right, it gives me able to sleep well. That we've been able to cover all, and there's no dots which are left to link. Confirmation of balances, this process should start well in advance, because you may need to send more than one reminders, and then a follow-up for propelling people to give these confirmations as much as possible, because this gives you a lot of evidence, direct evidence, outside evidence, the highest level of evidence which we can take on board. Banks, of course, confirm, but parties, debtors, creditors, it becomes we don't have a habit here, still of confirming these balances. If there's a request come, we just either we are fear of giving some wrong figure, or thinking it is just a formality and I don't need to respond. I'm anyway bogged down with my own problems. I just ignore that request. Fair valuation, how to value land. There is, a lot of elements involved which I have to keep into mind. So I'll have to have good valuers, independent valuers, the circle rates or other transactions reported with the registrar will sometimes they are available, sometimes they're not. And subsequently, how these have played around is also very important for me. Yeah, review of minutes of board committees, that's very important. But litigation aspects, because everything which is corresponding with the litigation, how I'm corresponding with the lawyers, and what is their look and feel of the cases, which is there. So I just talked about estimated cost to be approved by the management. Most of the time, if I see practically, we get the cost estimate by, the accounts team, in Excel sheets. This is how my cost is there. I'm not sure who has applied his mind. Have there been a sign off? These are unsigned sheets. So we need those charged with governance, the managing director, CEO, maybe the board, etc., to actually certify what they feel the cost is. Because otherwise, it can be denied or it can be changed overnight, and I am left with a very difficult situation. Costs would change, and inflationary conditions which most economies are facing, and India has been, the fact that cost of construction and cost of building has significantly changed over the years. This is one element which actually escalates far ahead of the other parameters. So the project model where revision is required has to be also documented, that what are the base rates I'm going to take, because there are various type of cement, steel, or other elements. Am I going to take the average, a weighted average, etc.? That has to be very well defined and accepted by the management. It has to be reasonable, transparent, and not prone to frequent change to suit my requirement, whether it is upward or maybe downwards. One important point is, if there's a material change in estimates, so change in management estimates is a disclosure requirement according to our accounting standards. So whether it will come under that threshold or not, I'll have to see as well. Project cost accounting, how do my selection goes for the vendors, for my contractors? Three-way match, from the PO, from the invoice, from my accounting is very critical. certification. Now, when building is being done, it's very difficult for an auditor to see what's being put. So as a management function, I need to know, I have a project management consultant who knows the technical aspect. Once the building is ready, I really don't know how much steel, cement, has been put inside, whether it is as per the specifications, the quality, the quantity. Not only it affects the quality of the building, but we really don't know if that much steel was required for this particular building, have I over invoiced, or there's something wrong. These knowledge, if you are having a technical bent of mind, rather than relying totally on outsiders, you should have some gut feeling that, in one building, say 100,000 square feet of apartment complex, how much steel would be normally required. If you Google it, ChatGPT may help you, everything is available. So I do my benchmarking, my internal thumb rule benchmarking. Similarly, for other aspects, landscaping, if I'm developing a golf course, how much soil is required, how much sand is required. In hospitality sector, how the cost per room for 5-star is 5 crores, for 3-star is 3 crores, and like that it works today. 10 years back, it was 1 crore and 50 lakhs. So all that is something available. If your interest should be, if you are interested in doing work in this sector, you should have knowledge of this sector. As if you are yourself a builder or entrepreneur or investor, how would you upgrade your knowledge? RA bill, RA bill is an old tested thing. It was manual. Now, I don't know how it's maintained in most organizations. It's computerized. How much level of detail there is, who's signing off, whether the person signing off has the necessary authority, are there any variations, etc. And then, of course, stock of building material, how the inventory is valued, whether it is physically verified, whether there's any impairment. And when I'm stacking it outside, the elements of nature can play a damaging role in spoiling that. And then, of course, direct cost and indirect cost. That is where a lot of issues arise. Administrative auditor's expense, will it be allocated to any project or not? For example, that's a small example. There could be large expenses. So only direct expenses have to be identified. There was a big question mark whether interest should be or not, but that's already solved. So we talk about that later. Data analytics, again, if you can use for larger projects, any red flags which are coming, even Excels and micros will also be very useful. Common cost for large projects I talked about. Each project, each tower, each element of real estate has to be taken care as a separate accounting so that the cost and revenue matches appropriately. In a large project, we may have clubs, malls, schools, each have a different element. Intent of the management that whether, the clubhouse is going to be run by myself or given out to somebody else. The malls, am I going to sell them or I'm just going to rent them? School is another level of requirement where I need to see whether what are the requirements of the local state to run schools, etc. Because those requirements are totally different. So all that is very important for me. And main thing is subsequent events in the balance sheet. We have the leverage or the advantage, maybe 1 month to maybe 7 months or 6 months. A lot may have happened. So all that is also very important and helpful for me. Inventory valuation. I may have inventory of, purchase price, property, plant and equipment, inventory, investment property, carrying value. All these have different connotations. Carrying value of inventory cannot comprise unrealized profits under IGAP, whereas property, plant and equipment, investment property is converted into inventory whenever. So when inventory is converted into fixed assets, there cannot be any unrealized profit. That has to be totally sieved off and accounted for or de-accounted for, I might say. Management identification of other costs, inventorized basis of allocation of overheads. It's more relevant here because it's not very clear. NRV testing of real estate projects. This is completed and under construction units, completed and not sold. This is very difficult and not an easy exercise. I can't put a valuer because these valuation norms, as I say, benchmarks are not so easily available. If it's a new project, a large project, a virgin territory, or the circle rates do not look commensurate to my selling rates, etc., it becomes very difficult. Similar projects, if I'm able to get that information, whether informally, formally, in the sense I reach out to the brokers, get something and keep that on file, or I'm available, it's available on websites, etc., of the projects being launched. All that is very helpful. Valuation report, make sure the valuer is of standing. It's independent. He or she has used the appropriate estimates, benchmarks, and assumptions, because valuation report can, it's so easy to have different valuers given different reports and they can all justify it. But is the justification, making common sense to me? Is it, is there some anomaly, or some red flag which is coming, and then I may want an independent valuation, which I may appoint rather than the management being appointing one. Capitalization of investment and property part. So the period of capitalization of the building, when I actually do it, conducting physical project visits to assess the physical process. So this is the physical visit I talked about. Component accounting, determining the parts of the building, how do I use the work, building, as I said, what is relevant to schools, malls, hospitals, real estate, hospitality, and clubhouse, and common area, non-common area, because now with RERA, now it's very difficult to manipulate. When I put a project on sale, whether I'm selling in super area, carpet area, or covered area, and the difference is so large, 50-60%, there's no benchmark. So everything and anything is covered under super area. The staircase, the common area, even the managing director's own office area is covered under that. So it's very difficult to, RERA has brought some semblance of control there, that you can sell it only on a particular way, carpet area, etc. So at least the buyer knows. And similarly, it helps me proper accounting. When I do the net NRV, I need to see impairment, whether it exists, what is the methodology. Like I mentioned, valuer has to see future projects, ultimately, actually, how much revenue I can realize, what is the weighted average cost of capital, growth rate, current leasing profiles, etc. And this may change. This changed very. Interest rates went from 5% to 10%. And for borrowing and lending, etc. So the whole scenario has changed worldwide. From America's went to 0 to 5. Never heard of since the 30s. We've not had continuously so high rates of interest. In fact, so many people in America, because the interest rate was 0 and they could lock in for 30 years, 0, literally 0, to buy properties. And now the property values have crashed, so they don't know, they're facing and nobody's buying because the 5% the interest rate is unthink of. It's like maybe 25% for me in India, which I can't survive. So probability weighted scenarios, that's very important. You have to do weighted analysis. You need to assess on sensitivity are there. Board approvals, basically the sections of the Companies Act would kick in. I'll have to be very mindful of, 186, 185, those sections against 370, 372, the erstwhile Companies Act, how they are panning out. In terms of the grants, if there are some grants or PLIs, government is giving some benefits, there may be some other rationale to take grants and how they have to be built in. So review the valuation, obtain the recent audited financial statements of full loans. So if I've given money, I have to see their net worth. If it's just the land and underlying land, I'll have to then value that land as well. Land aggregating company or if you have given an advance to them, this is a common problem. I've given to 100 companies, small companies. Their land value may have fallen down, maybe stagnant, maybe some sensitivity required, some impairment has to be built in. So to be able to persuade them, whether they are under the control of the management or it's some unrelated enterprises, brokers, etc., how do I satisfy that the money I have given? So the builder is confident that ultimately he will recover the money, but ultimately is a function of time. And as an auditor, I unfortunately don't have that luxury. I have a cutoff date today. So if I have to, see the reasonableness of the probability of the project being completed in time and in good measure, then I need those valuations. So booking of interest on cancelled flats. This is another area, which is very nebulous. The moment I enter into agreement, I have the buyer has an obligation to pay interest for delayed payments. And very often this is there because of EMIs, bank loans not being sanctioned, change of job, loss of revenue for the owners. So immediately there is a notice coming from the builder. Even though the project is delayed, but that notices of the builder would keep coming for interest. So I can account for it conservatively on an estimate that what actually I realized at the end of the project as an estimate based on past experience, or I have to start booking it the moment I raise that credit note, debit note, etc. Similarly, if there's a delay in the project, I'll have to book the interest for which delayed payment I have to give to the buyers. So there's again a big issue of estimation, like gratuity, etc. I have to make those assessments which are not so easy and not well documented. GST booked, not booked initially, first stage GST, then second sale not. Similarly, these registration charges, which stages, who will be paying it, how it works. Brokerage, that's again a nebulous thing. Brokerage also gets into a different category at points of time. So then we have entity review of compliance procedures. Basically, if I'm listed company, SEBI, LODR, accounting standard, Ind AS requirement, INGAAP requirement, shareholders meeting, minutes of the board. Basically, more important, what are the policies and procedures and practices? So real estate companies have the least level of governance as a general statement compared to most other industries for various reasons I talked about in the beginning. But they may have good practices, but these practices have not been documented into processes and sub-processes. So if there is a change in incumbent, the salesperson has changed, or the accountant has changed, or the engineer has changed, I may get different parameters of reports. Unless I have a well-defined process, a SOP, and these processes have been the training has to be imparted to the people down the line to be able to consistently follow. So in one city, one location, one project, they may be having another way of looking at things in some other way. So there could be challenges there as well. So I have to be very consistent. And the only way is two ways. One, I have to have these well-defined processes and sub-processes. And also, I'll have to get into training to my staff down the line to be able to understand what they are, and so that I can follow them both in letter and spirit. There are always concerns on disclosures of related party also, but that is for any such transactions. But here, where there are nebulous companies operating under some umbrella, which may or may not be under the same definitions, it becomes very onerous on the auditors. So corroborative evidence through getting external confirmations from related party, including the terms of the arrangement, arm's length price establishment again becomes a very big challenge because of the inherent nature of this industry. So that also have to be. So materiality has to be there. Those charged with governance, their mindset, the culture of the organization has to be seen, whether they are prone to compliance or prone to non-compliance. What are their objectives? Wanting to save tax or wanting to show good numbers so that they can build in their cash flow and get bank loans or maybe FDI. Are they over ambitious in terms of multiple projects? So then, the diversion of funds comes into play, or they are conservative and starts, selling only when a substantial portion is complete, or they will break ground and show that some land, Utopia land is being bought and project is launched, and then people will rush to book. And at the end of the day, after years, they have nothing but a lemon to work with. So the culture of that organization, of the management, of the history of the real estate group or the company is very important. It gives me a lot of idea of how my testing will happen, my extent of my sample checking, my depth, etc., and my interaction with the management, and whether I should get into people whose track record is suspect. And the phase of the real estate in the country, because it goes through the biggest upheaval. It's never consistent. We've seen it up, down, and that's the uniqueness. So if it is a buoyant market, there is so much of euphoria like it's today. Things become comfortable. Sometimes it is absolutely flat, or it's actually no buyers in the market. So even if I have to sell, I have to, even if a desperate sale is not happening, I'll have to be very mindful. RPT I already talked about. Then I can go to borrowing cost capitalization. If the borrowed cost are temporarily parked in mutual fund fixed deposit, such income needs to be adjusted against the project cost. So one-to-one correlation is borrowing cost capitalization in case of acquisition of land for the purposes of project development. I do that. But interest cost, for example, whether to capitalize in a running project, general borrowing cost, specific to a project borrowing cost, all that considerations will apply. There are too many scenarios. Typically in inventory, we cannot carry interest costs. And most of the builders were doing that. But now it's very clear. There's no ambiguity. Because under Ind AS 115, borrowing cost not to be included as a measure of progress while computing revenue recognition under POC method. So my friends, that's very, very clear. Earlier, we were not very sure how this was happening. But over the years, more and more clarity and guidance has come from the Institute and the Ind AS standards. So interest cost charged by parent to subsidiary and treatment in standalone financial statements. Subsidiaries capitalizing the cost in the inventory, then how do I consider it in my books? And with that, when it is not a subsidiary, but it's a related party, or joint venture or unrelated party, how do I treat that also? Because the valuation will be impacted. We have other considerations, my friend. Basically, customer claim and related litigation, the biggest problem for headache for real estate sales. And there are hundreds and thousands of suffering, lakhs of flat buyers or flat aspirants caught into years and decades of litigation, land litigation, because if there is some land I procure and start construction, but there is a counterclaim because of some family issue or because the land records are also nebulous. Sometimes these are panchayati land, there's Lal Dora lands which don't have these proper trail. So it becomes a litigious issue. There could be invariably escalations, arbitrations with the contractors. This is a norm. You get into a contract with lesser value and then you start putting claims for cost escalation, because who will decide the delays on whose part, whether land procurement was there or whether the plans were not sanctioned, whether there was some other environmental issue like floods, or nowadays construction is banned every second day in Delhi NCR thanks to the GAR. So, whether it's a force majeure or it is something which I have to take into the stride, who knows? A deferred tax asset. So this is again, virtual certainty against reasonable certainty. India has given some respite. Now we talk of reasonable certainty, because virtual certainty, unless it's realized, it's impossible to say. In the VUCA world we live in, it's nothing can be certain at all. And more so today. So we have carried forward losses, whether I'll have time to adjust it in the next few years. Number one. Number two, my POCMs have brought in revenue in my books, but I find today when I do a reassessment that things are not moving, then I have to go back to the drawing board and kind of de-recognize all the deferred tax assets, which is, management sometimes, they are very confident that ho jayega, but, ho jayega, kab hoga, kaise hoga, kyun hua, kaise hua, kab hua, ye sab swal, it becomes very troublesome. And we have to have that guts and the acumen and the finesse to be able to convince we should not found to be unreasonable with the management or those charged with governance. We'll have to convince them that, sir, this is not acceptable. Ye meri Lakshman Rekha hai. This evidence is not on record. This is your thinking and your earlier, success rate does not give any measure to this market, which has a very opaque future. We don't know what happens. There could be a significant fall. There may be again a big jump in real estate market. Nobody knows. If you ask somebody what happens, nobody knows. Even today, if I ask somebody, I've asked that whether prices have gone up, double हो गया, अब बढ़ेंगी कि नहीं बढ़ेंगी, किसी का आंसर नहीं है. It's like the stock market. It's not linked to the underlying value of the assets, and it's not very smooth. Stock market, still you have a trading platform. Here there is no trading platform. It's all in the air. Going concern. Now, again, I'll have to do an assessment. If there are delays in the project, projected cash flows, are they approved by the management or those charged with governance? Are they fair and reasonable and conservative? Each auditor may have a different view. Written representation is fine, my friends, but it's not going to absolve me. I'll have to do my own skepticism analysis. Just a couple of points which are relevant in real estate as well. So it's an audit trail mandatory from 1st April. Now we are end of the year. I hope all of you have geared up for this, because audit ही हम साल के बाद करते हैं, तो उसके बाद हमें लगेगा कि 1st April को क्या था, nobody knows. So you have to get into this much. We're already too late on this. Records maintained, when was it done, who was doing it, and what really happened when the recording happened. So whether my accounting software, whether it's Tally or ERP, have a feature of recording audit trail, and it is enabled, which means that it was operating throughout the 365, and maybe now this year 366 days, thanks to leap year, or it was switched off for a few days, or maybe it was an outage, or there was some technical issue, or whether it was done for any ulterior motive, I don't know. The tampering could have taken place. Very easy to tamper. We are not IT savvy, and we are, as auditors, are not wired to get into the IT immediately. We may need experts, or we may qualify ourselves under the certification of the institute, but that doesn't give me clarity on the practical aspect. I have to preserve these for 8 years, etc. Implementation guide is on, but that's another topic for discussion. NAFRA has come down, reviewed real estate projects and also other companies. And they have talked about, as an auditor, I have to be very mindful of the independence, and how do I rely on the technical work, and whether I am independently evaluating this technical work of estimation of cost of projects, impairment of inventory and property, plant and equipment. What is the legal opinion provided by the management and taxation experts? Or I'm engaging these lawyers on my own cost, maybe reimbursable later as my audit fees, to get an estimate, because legal opinion is very good. Lawyer has no obligation. He has no UDEN. He has no obligation. There's no, disciplinary proceeding if the opinion doesn't go wrong, because he anyway have these so many covenants of limitations. And in my opinion, this is recoverable. So 50% more, 26 years, make a provision. I am very safe, but if it is not 50%, then my head is on the block. So that becomes very difficult also. Risk of material statement. When I start an audit, I have to do my audit planning, my risk assessment. I'll have to do a lot of scoping. And this is where most of my time is required. And as auditors over the years, we have not focused on this, my friends. We have to understand the risks beforehand. We need to engage with the management, how we understand their industry, my third eye principle, the culture of the organization, the industry and location, and the times in which we are operating will give you a lot of help in scoping the document, what my sampling would be, what my key areas of thrust would be. That is something which is missing for all the medium to large, even large or not so large or CA firms or individual firms. उसमें मुझे बहुत ध्यान देना है. इससे ज़्यादा आज की डेट में रिक्वायरमेंट नहीं है, because something which as for years we never did it as Indian firms, Big Four etc. may be doing it for large number of years, but working paper के लिए I need to be very, very mindful that how I'm keeping this. Qualifications, I may give an UM and not a qualification. I may give a qualification, but it requires an adverse or a disclaimer of opinion. All these become very relevant, because these are large projects. These are large. It's not, debtors over multiple debtors of thousands of customers. There's a lot stake here. So, and this lot is happening in the future. The moment I start with real estate project, it's not the time gap in starting and completing could be decades. Unlike most of the industries, it could be weeks or days or months only. External quality review is also very important, that very effective for how they are assessing it right from the beginning, not a formality after the audit report is signed. So this is all I have, my friends. I'm going to stop my screen. I'm sure Gulshan ji and others are there to navigate the questions and take it forward. I'll just put my video off for better internet. Thank you. Thank you once again. Gulshan ji, you are on mute.
Can you hear me, sir?
Now we can hear you.
Thank you so much, sir, for such a wonderful deliberation. Now we have received certain questions, sir. May I request Gulshan sir to please start the proceedings of this question answer session, please?
Thank you, Suman sir. Thank you, Anil ji. I am just going to take the question. We have received few questions. We'll start.
Right.
The first question we received is the participant asks, the customers in real estate are also recognized as consumers in recent court judgments.
Right.
What extra precautions an auditor is required to consider in auditing of trade receivable in real estate industry, specifically in recognizing contingencies related to customer deliverables? Right.
So, Gulshan ji, the answer is very clear. There is no difference in accounting treatment of trade receivables. Trade receivables of whatever nature are the same. In all cases, we need to assess impairment and whether revenue recognition needs to be continued, has to be examined, or needs reversal. This goes for most of the cases, and the penalties or interest as decided by the consumer code need to be examined and recorded. So formula वही है, application में आपको थोड़ा ध्यान रखना पड़ेगा.
Second question is, sir, please explain the tax aspects on JDAs with builder, and please explain taxation in hand of landlords.
So this is a question for the tax guys to answer, and I would always go to my tax partner to help me navigate this. So I really don't want to get into this, but you see, each it doesn't fit. Each GDA doesn't fit each other. Each has its different elements. When is the risk and reward being transferred? क्या लक्ष्मण रेखा है? लैंडलॉर्ड के हाथ में कब इनकम बुक करनी है? कैपिटल गेन्स कब आएगा? Mostly, I would say practically, if I am giving simply my land in somewhere in NCR or anywhere to a builder, I give him all the rights to do whatever he has to. I have a control. I can, if there is a default, I can take back. But in more sense than not, I have given up everything the moment I signed that JDA. So I have to start recognizing my capital gain then. Being conservative, take your indexation benefit, put your money into further real estate, and then, mitigate your tax rather than postponing it. That's my suggestion.
Practically,
so there could be litigations, etc. But, बहुत ज़्यादा cases litigation में भी small percentage है. And if the JD is clear that I have given the rights to a reasonable transfer of ownership and control to the builder, then capital gain kicks in.
Yes. Third question is how to ensure that work certified and valuation of inventories have been correctly evaluated. What are the steps to check GST compliance have been correctly? So same participant asked two questions together. One is about certification and valuation of inventory, and another is about GST compliances. We need to take any specific care around that.
So GST is the most complex law under the sun today, sir. 26 states, every day it's a new law. Unlike income tax, which has kind of, unlike other than, transfer pricing, POEM, GAR, new things which are happening, and ELMA, but income tax has been kind of developed through Palkiwala's eras over the decades. And apart from the tinkering of numbers of sections of this percentage, that percentage, we have a fair idea of how taxes are. The clients know much better. The auditors or tax consultants know, and even the department is very well versed of. GST में तीनों नहीं है. क्लाइंट को तो बिजनेसमैन को तो आइडिया ही नहीं है. जीएसटी जो इम्प्लीमेंट कर रहे हैं उनको भी क्लू नहीं है, और जो प्रैक्टिशनर्स हैं वो भी इवॉल्व कर रहे हैं. 5 साल हुए हैं, ऑडिट्स अभी शुरू हुए हैं. ईच स्टेट हैज इज ओन वे ऑफ थिंकिंग. ट्रिब्यूनल की कोई डिसीजन आई नहीं, ट्रिब्यूनल ही नहीं है आज की डेट में. तो IT-80 जो 50 साल से हम देख रहे हैं, जजमेंट्स बहुत बढ़िया दे रहे हैं इनकम टैक्स में, जीएसटी का सी स्टैट में आता है, फिर आगे जाके हाई कोर्ट में जाना पड़ता है. आज भी एंटी प्रॉफिटेरियन का है, 50 कंपनियों को इफेक्ट हो रहा है. नोबडी नोज how the law is evolving. So GST may always take one or more than one advice from technical expert. I am not, going to talk about this because I'm not competent, and I don't want to get into that area because it's very, very nebulous.
Right. The question is around the inventory valuation and work certified by experts. What all we need to take into consideration as auditors.
Sorry, I missed your first line, Gulshan. Sorry. Can you repeat the question?
Yeah, I'm saying now you touched upon your during the session on the valuation of inventories.
Right.
So one of the participants have specifically asked about work certified by experts and how, and as auditors what procedures we can perform to have sufficient evidence on the file. Maybe you can touch upon again.
Yeah, surely. So I have to rely on experts, yes, but I have to rely on experts with open eyes and ears. Whether it is all these experts, whether we have been doing actuarial valuation for my labor and staff for gratuity or leave encashment, or doing fair value assessments from valuers, or I am taking legal opinion on the probability of some contingent liability coming in my way, or as an income, or as an expenditure. So all these will have to be done with skepticism. All this will have to be done with very due care and consideration, whether the assumptions utilized are fair, whether the assumptions are actually mentioned. So if a legal opinion lawyer gives a cryptic legal opinion that, in my view, this sanguine hope that this case, the client has a sanguine hope of winning this case, that's not good enough to me. Are there case laws against me? Are there case laws in favor of me in the precedents? What are the facts which leads me to this conclusion? And what are the laws available on the subject? That have to be explicitly mentioned. And if I'm not satisfied, I have to immediately, without much ado and wasting of time, go to an independent lawyer, which I'll have to engage myself to get a fair assessment, especially on material transactions. Similarly, on valuations, what are the parameters, the assumptions? Can I do a sensitivity analysis? It is just on the threshold for valuation, or there is a very large margin available to it? What is the culture in the market? The trends what are happening, it is a downward trend or an upward trend. वो सब चीजें मुझे अपना ही assessment करनी पड़ेगी, as if I am doing an independent evaluation of the valuer and giving him marks on a scale of how he's done the valuation. Then only I can rely on it, not otherwise, sir.
Flats and buildings, so I'm skipping.
Right.
I have this many. Bharti ji, you can take it forward. More questions if you have.
Anything?
Sure. Thank you, Gulshan ji. Thank you, Suman ji, for such an insightful session. It is I'm sure it is helpful for participants. I have few questions received from participants. I'll just take it up. So question came is, Under Section 269 SS allows amount not exceeding rupees 20,000 to be received in cash for sale flats by real estate company. Is it true that RERA provisions are stricter and require entire consideration to be received by cashless?
I don't have an answer to that. It can be. So, Bharti ji, some of these questions which I don't want to answer and make a guess, because unless and I'm 100% sure, I don't want to do it. So is there a process of replying to them separately? Or we conclude this and then, for another time, generally how it happens?
Sir, you may please forward to us, then we will forward to the concerned member.
Right. Okay. ठीक है.
Yes.
So that proper answer आना चाहिए. I don't want to give something which, I'm not 100% sure.
Yes, sir.
Sir, another question came is, what are the laws and regulations applicable on real estate sector?
So I mentioned a lot of laws covered in the presentation. There are laws which are common laws like labor laws and other laws, Indian Contract Act, etc. Very important. But RERA is the latest law. Urban land ceiling is the latest law. Then there is, Benami Act is a critical law, most relevant to real estate, especially in land aggregation. And there will be very straight many laws, because there will be laws on how much you can, aggregate, what are the permissions required for usage, whether it is commercial or residential or mixed, and whether the land use laws, which are specific to not only to a particular state, but particular district or area, especially when the development is happening across the country. Now we have a new airport coming in Greater Noida, how the land has been treated around that. If there is a highway coming or a railway track around that land, commercialization has to take place. So I bought it as agriculture land. Now it's on some other footing. So the conversion of land use is another area where real estate works. But RERA is a very big thing as far as it covers the entire gamut of services. So what I have to read the RERA law of the relevant states, understand the requirements, see how the management is complying. So not only I'm doing a check from that part, but as an auditor, as record to report, I get a lot of comfort that what is being reported there. If there is any anomaly, I'll be able to pick up. Plus, जो वहाँ पे schedules और notes हैं, वही मेरी एक audit query बन जाती है to ask my client myself. So, immediately the data is flowing to me in a very structured manner.
Okay. So next question received is, in percentage completion method, where the tax is paid, how do one adjust the tax paid on retained or unsold unit?
So revenue is to be recognized as per, the ICDS, basically income tax disclosure standards, income computations disclosure standards. Unfortunately, there are too many standards I have to comply with. But when I file my return of income tax, I'll have to file it under the ICDS. So in the tax audit itself, there is a schedule of reconciliation कि मैंने accounting में क्या करा है और ICDS के हिसाब से how I'm doing it. So those standards will be relevant. You'll have to deep dive and address it specifically. But one thing I can mention in this ICDS is that which states that the POCM has to be applied when 30% work is complete. This is also, as I mentioned earlier, I can't start booking, I have a leverage of not started booking revenue. So if a builder is there, am I wanting to save tax, then I use a conservative model for building revenue. But if I'm a builder and I'm not worried about taxation because of various reasons, carried forward losses, or I don't mind paying tax, then I may want to show a higher revenue. So ICDS is very clear on that. I'll have to be very mindful of that. So definitely unsold units में वो inbuilt tax रहेगा. I have paid tax on that because POCM and method allows me. So cash flow and revenue are the most diverged aspects in this sector. And that is the reality. Some can follow, some cash flow can follow the revenue recognition or otherwise, depending on the stage of the project.
That's so true, sir. Thank you. I'll take up next question, sir. An apartment promoted 25 years before is reconstructed with an additional floor. JDA signed by all the owners existing. Total apartments after construction will be 10 numbers from the existing 8 apartments. No cost is incurred by the existing owners. Will it come under RERA? Any thoughts on LTCG?
So, it's a very complex query and facts need to be got into. But just off the cuff, top of the line answer, you see, RERA, of course, if it is applicable, I can't say retrospective old agreements, etc. State-wise, it is actually different, and there are a lot of courts which are under, discussion. If what is the extent of retrospective application of RERA? But long-term capital gain shall need to be computed. If it shall depend upon purchase price, circle rate of property, cost of construction of the apartment. So long-term capital gain to आएगा ही.
Okay.
और वो तभी होगा, when I pass the threshold of how when my right to those apartments have come into my fold, and that's the trigger when the transfer takes place for long-term capital gains.
So you mean to say that, let's say if there are 10 apartments now, but owner remains 8 owners. So as the ownership is as per the new JDA, that's how the taxability will come.
Yes, exactly. Change हो गया ना, पुराना तो खत्म हो गया. It is subsumed in the new one.
Correct. Okay. Sir, I'll take up next question. Please enlighten us with the method of valuation of inventory of WIP or the complete flat shops in hand.
Can you bring that question again? It's not very clear.
Looks like, sir. Please enlighten us with the method of valuation of inventory of work in progress or the completed flat or shops in hand. So I think the participant is trying to ask the method of valuation for the inventory of the flats or shop, which is either completed or the work is in progress. So basically, I think a retail complex is getting constructed.
So typically it is cost on net realizable value, whichever is lower. That formula will work for all assets. And if there is work in progress, what are the elements of work in progress? Have I loaded in with interest or other elements? What is the age of the work in progress? Is the construction period longer? Is there an impairment possibility? वो सब complications आ जाती हैं. And that requires more insight and more backup documentation. As far as confirmed shop is concerned, typically again cost versus net realizable value. But net realizable value is probably more easily available, and it is already covered in the presentation. And then I know what the sale rate of those shops are, how much they are selling. So it becomes easier. Process is the same, cost or net realizable value, whichever is lower. But in WIP, it's more complex, and I have to do a deep dive. In shops, it may be much easier because of availability of information on finished shops.
Okay. Sir, I now take up the last question of the session. In JDA, is it necessary to use POCM or completed contract method, which is appropriate from the tax angle?
So, ma'am, it depends actually on the JDA, whether to share revenue or space, and IGAP and India is followed. Basically, कौन से accounting standards लगे हैं, India में अलग है, IGAP में अलग है. Tax comes from the ICDS, तो वो एक another standard आ गया. As no completion method for tax purposes में completion method है ही नहीं. So in India में completion method आता है, which is point in time, and IGAP में point over time आता है, and then ICDS में completion method है ही नहीं, वो POCM में जाता है. So all these things, but it is specific to JDA. Most of the JDAs would require, unlike India's POCM, simple POCM to be applied. And if, of course, in India's is there, then completion method contract will kick in. But for ICDS taxation, mein to aapko completion, I think, is not recommended.
Okay. Understood, sir. Thank you so much, sir. Now I express our deep gratitude to all the participants as well as Suman Chadha ji and Gulshan ji for contributing to this enlightening session. I hand over proceeding to Mr. Anil.
Yeah. I also
Thank you so
want
much,
to
ma'am.
Yeah, before that, I must acknowledge my audit partner, Ashish Gupta. He was my chat GPT in the sense, all this presentation, he's helped me build up because he does the audit on ground. And I must acknowledge his support to me in, understanding this and revising my own, legacy of how I actually was doing these audits when I was on the field. Thank you.
Thank you so much,
Thank
sir.
you.
Thank you so much for your expertise as well as the knowledge shared by you with all our participants on this key audit matters on this real estate sector. Thank you, Ashish ji. On behalf of AASB of ICI, once again, I extend my heartiest thanks towards you, sir. Whenever I call you, you always support me as well as always give your consent. Apart from having busy schedule and apart from having the daytime during the office working timing, you have given me the time, sir. Thank you so much for your precious time, sir. And I
You're
also
so
thanks.
persuasive and so nice. So आपको मना करना बड़ा मुश्किल है.
Thank you so much, sir. Thank you. And I also thanks both the moderators, Madam Bharti ji and Gulshan Grover, sir. Gulshan ji was also busy. Madam was also busy. They have given us our time, their time. Thank you so much for moderating this webinar in a very successful manner. And also, as sir mentioned, I also thanks to Ashish ji also for support given to all of us for this webinar. Thank you so much, ma'am. Thank you so much, sir. Thank you so much.
Thank you. Thank you so much,
Thank you.
everyone. Thank you,
Thank you.
participants.
Bye bye.
Thank you, sir.
Bye.
Thank you. Thank you.